Today I thought we'd do something a little bit different. I thought we'd try a longer episode where I cover like 10, 11 different stocks, different topics. We got a lot of different things to cover today, so I thought we'd try different. We're going to start off with the NFL with a big deal with Genius Sports, which is a small company. It's a SPAC that is merging. And then after that, we're going to go over some news with Tesla, their deliveries, with Canoe, their partnership with Hyundai. We're going to go over Palantir. We're going to go over AMC and GameStop and a couple of other things. So make sure to stick around for the entire episode. First off, the National Football League just agreed to a data rights deal with Genius Sports. And this is a really big deal because right now, Genius Sports is a very small company. They're not like that large, and they're going public through a SPAC merger. Currently, their stock ticker symbol is DMYD. After hours, once this partnership was announced, the stock rose over like 25% just from this deal. During the day, it rose about 6%. So in one single day, rose about 31% from this deal with the NFL. And I think it could go much higher from this. So this deal makes Genius Sports the official data provider for NFL games. They're going to distribute real-time play-by-play stats. They're also going to provide sports betting data feeds to media companies and sports betting firms domestically and internationally. This deal is valued at about $1.5 billion over the lifetime of the deal for Genius Sports. It's a multi-year agreement. It's a contract with the NFL, and I think there's a lot more room for them to grow. This is just the beginning for them because right now, Genius Sports is the number one holder of official data rights with sports leagues, and that's a pretty big economic moat. It makes it hard to replicate for other companies, hard for other companies in the space to replicate the size and scale, number of relationships that Genius Sports already has in this growing industry. So right now, they distribute official sports data to sports books, sports leagues, and media companies. And right now, their customers, they have this major deal with the NFL, but other customers they work with, they enter like multi-year agreements to access real-time sports data. And analysts believe that the total addressable market for the company was about $1.6 billion in 2020, but I think that's going to double by 2025 to $3 billion because sports betting market is growing very rapidly. We're seeing more and more states legalize sports betting. And really, within the next couple of years, we're expected to see almost all of the states legalize sports betting. A couple of risks of investing in them. They do have a pretty high growth rate of around 25 to 35% year over year. Analysts are like the risks is that there could be slower than expected legalization of online sports betting globally. I don't see this as a big issue because eventually, all states, most countries are going to have legalized sports betting. We're seeing Canada have a big push for that as well. So I don't think that's going to be a major issue. It may take a little longer, but I don't see that being a real obstacle. And the other risk is inflation of data access rights from major sports leagues. So right now, good thing with Genius Sports is they are the number one holder of official data rights with sports leagues. They have this major partnership with the NFL, which is a multi-year agreement. It makes them the official data provider of the NFL. And I see this as really a huge deal for the company. Going to provide billions of dollars in revenue and it could open the doors for a lot more opportunities, a lot more partnerships down the road. So really, I don't look at this as just a deal with the NFL, but I see this as being like a major platform that they can then use to open up into having smaller deals with other smaller companies over the next couple of years. So right now the stock ticker symbol is DMYD, and I see this as a long-term play. Still, the merger has not yet been completed, but it is a SPAC. But this is still a really big deal because then they're going to get funding from the SPAC merger. They can use that money to push for marketing. They have now the money from the NFL deal. There's a lot to like about this company. Speaking about a lot to like, though, Tesla, they just delivered 184,800 vehicles in the first quarter of 2021, and This was all while their Model S and Model X production dropped to 0. So they absolutely crushed expectations, did so much better than all analysts were expecting. Yet their Model S and Model X production dropped to 0 because they've been working on installing new equipment, testing, upgrading their production lines for these vehicles. So they didn't make any of them. And this is a big deal because in the fourth quarter of 2020, Tesla had produced 16,097 Model S and Model X vehicles. They delivered 18,920 of them. And basically they just took that out of the equation entirely, yet they still delivered much more than people were expecting. This beat their previous record of about 180,000 vehicles. They beat that by 4,000 or 5,000 vehicles. This was their best quarter ever in the history of the company. And what people don't realize is this was without the production of 2 of their models. This is without entire production of 2 models. They still delivered about 2,020 Model S and Model X vehicles from their inventory, but they didn't produce any more. So being able to have a record-breaking quarter without producing 2 models, in my opinion, is absolutely insane. You don't see that very often with 2. It's not like they have dozens and dozens of models. They have a pretty limited number of models, yet 2 of them they didn't produce at all, and they still had a record-breaking quarter. I think it's very possible that we could see them deliver 1 million vehicles in 2021. They're on track to doing that because they're growing at a pretty consistent rate, pretty fast rate. And they already delivered about 180,000 vehicles in the first quarter. I think it's very likely that we could see them deliver 220 to 230,000 vehicles in the second quarter of the year. And this could push the stock price up significantly higher. I think we could see it double very, very quickly. And speaking of stock price doubling for Tesla, Jim Cramer came out and basically said that he thinks Tesla stock to $1,000 per share is very, very possible. He responded to a tweet just the other day which suggested Tesla stock should jump to $1,000 and hit $1,200 or more in 2022. He responded to this by saying, "It's aggressive, but not out of the ballpark at all for Tesla." And this is really big news. A lot of top analysts, the price targets for Tesla are not the best, not the highest, considering where the valuation currently is. A lot of analysts are not extremely bullish on them. We know Cathie Wood and ARK Invest think Tesla can hit $3,000 per share. That's their base case. Their bull case is $4,000 a share. So they are very bullish, but it's nice to see a lot of other people starting to see the real potential of Tesla, their stock price moving forward, because with their record-breaking quarter in Q1 of 2021 in terms of deliveries, considering they didn't deliver any Model S or Model X vehicles, it's nice to see that other analysts are starting to really realize the real potential they have, because it's not just about their electric vehicle their sales. It's also about their solar energy business, which is starting to get off the ground. I talk about that in my podcast. About a big deal they just had with Apple with the solar business, also their energy storage business, their battery business, eventually robo-taxis, autonomous driving, and all the subscription services they can build off of that could be in software revenue. That is where really people see Tesla going in the future. That's where the massive growth is going to happen, because obviously they're going to continue to sell vehicles, but there's only so many vehicles you can sell. There's always more they could do with software, energy storage, batteries. Those things are needed, and that's really where, for some of the main reasons why ARK Invest sees Tesla hitting $3,000 a share. They see Tesla hitting $3,000 a share because they explain that they see Tesla manufacturing between 5 and 10 million vehicles in 2025. I think that's very, very possible. Now that we're this year in 2021, I think we could see them hit about 1 million vehicles a year. They also say that Tesla has a 50% chance of delivering fully autonomous driving by 2025. And they have a possibility to even launch a human ride sharing service like an Uber or a Lyft. So Jim Cramer, he came out and said that $1,000 or $1,200 price target by 2022 is definitely possible. And according to Tesla in their most recent press release, they said that they're encouraged by strong reception of the Model Y in China and are quickly progressing to full production capacity. They explained how the Model S and Model X have been exceptionally well received, and now that they're going to start ramping up production of those, I think there is no way we won't see the next quarter have over 200,000 vehicles delivered. Like they did 180,000, 185,000 in the first quarter. That was without the Model X and Model S. Now with those added on, I think it's very possible we'll see. I feel like it is not just possible, it's very likely that we'll see 200,000 vehicles minimum delivered in the second quarter of 2021. Next up, Canoe stock. Their stock is cratering. Stock ticker symbol is GOEV. It's down over 50% from highs. It's now under $9 a share, and many analysts are saying that this is like a screaming buy. It is just extremely undervalued right now. Main reason why the stock price has been dropping so much recently is really because they had one of their first investor calls with a recent earnings report, and there have been a couple changes with management, and the deal with Hyundai appears to be completely dead. So originally, a couple months back, and for the last about year and a half, Canoe has been talking about a partnership with Hyundai, and they've been explaining how their business model was going to be to really be like an engineering services line, selling their software to other companies. At one point, there been interest from Apple to have a partnership with them, and basically all of those deals, all of those partnerships are no longer in play for the company. During the recent investor call, their CEO, it wasn't a great look for the company. Let's just say that. So their CEO was absent from the call, and the company announced earlier that same day that their CFO had resigned to take another job. That was the second departure from a high-level person in the company in the recent weeks. They lost their head of corporate strategy, so they lost their CFO, head of corporate strategy, and the CEO wasn't present at the investors call. Despite all of that, though, despite that happening, and despite the deal with Hyundai basically no longer being in play, that doesn't affect the value of the company at all. So, according to the investor call, they explained how what they're going to be focusing on now over the next couple of years is going to focus on making and selling their own vehicles. They explained how they've had a lot of demand for their 3 vehicles, one of which is their pickup truck, which I spoke about in a recent video, my recent podcast. They've had a lot of demand for their pickup truck, and they say that they want to focus on making and selling their own vehicles to consumers first. Later on, they'll focus on their partnerships. There'll always be partnerships out there. They can work on those later. So while they did change, their business model from trying to really focus on these partnerships and maybe some software, licensing things out, to now working more direct with consumers and focus on selling their vehicles, in reality, the changes in management, what happened with the investors call, do not impact the company's core value at all. Core value is really around its intellectual property, its IP, its technology, its engineering team, and none of that has changed. None of that has changed at all. They still have their skateboard technology, which is essentially the platform that they put the cars on. It essentially looks like a skateboard where the vehicles go on, and it can be used across all of their different models of vehicles. So right now, the only thing that's changed is how they plan to monetize their IP. And that's just focusing on making it and, selling their own vehicles first, then worrying about the partnerships later. So the problem with this, it's not just all positives, it's not all negatives. The positives are, nothing has changed with the real core value of the company, the intellectual property, nothing has changed there. The downsides are, that partnership with Hyundai brings a lot of positive press and things like that, no longer there. And also, by focusing more on making and selling their own vehicles, that could lead to less revenue in the short term and could hurt the prospects short term. Long term, though, it will result in higher profits because they're selling and making their own vehicles. So there's some, give and take with this. Not all positives, not all negatives, but still at under $10 a share, It's off nearly 50-60% from where it was at all-time highs just a couple of weeks ago. And when we start seeing these tech stocks bounce back, I think we're definitely going to see Canoe, stock ticker symbol GOEV, bounce back as well. Next up is next week, the week of April 5th, 2021. Could be a very big week for the stock market. It's looking like it's going to be very positive. We're going to see a lot of growth, and a lot of companies have great weeks for their stocks for a couple of different reasons. The first is the jobs report was much better than expecting. The U.S. Labor Department, they released a surprising March jobs report that showed there were 916,000 jobs added in March of 2021 compared to only 675,000, which were expected. So they beat the predictions by economists by nearly 50%. So they did 50% more than what economists were expecting. And typically when we see these job reports come out on like a Thursday, and then we see, trading on a Friday, typically when we see these reports come out, the stock market really has been watching them closely for the last couple of months. Ever since the pandemic started, these job reports are more important than ever, and beating expectations by 50%, 675,000, which was what was expected, versus 916,000, which was what actually happened. That is a big deal. And on top of this week, there's not too much that's going to derail the stock market. Like, things looked well towards the end of last week, and there's not too many big events that are going to be taking place. The Institute for Supply Management Service Sector Survey will be released on Monday, and that should get some that's expected to be really, really good. The Institute's manufacturing survey came in at the highest level it's ever come in since 1983. So should be okay. That should be good. And economists really now are just shifting their focus to looking at very strong second quarter earnings and earnings report as they start to come in, because they're expected to be very good, very better than expected, because of a lot of money that has been spent with stimulus as the economy starts to open back up. These earning reports are expected to be positive for stocks, and they're expected to be much better than expected. So right now, really, the macro calendar is pretty light. According to head of investment strategy at Citi US Wealth Management, he said the biggest thing looking forward is just going to be earnings. And typically, another positive is that April is typically a good month for stocks. Like, April has been historically bullish for stocks, especially when we see March 31st and April 1st have positive days. When the market closes higher on March 31st, and when it also closes higher on April 1st, historically, ever since World War II, if those 2 days are, close higher, well, then April typically has a much better month. So typically, if those 2 days, March 31st and April 1st, are higher, the average return for the S&P 500 for April is typically 2.4% versus if they were down, which would be 1.3%. So typically, April is good, but with these 2 days, March 31st and April 1st, closing higher, it's expected to be even better. So bottom line is, this week, not too many big events. We have a couple of events on Thursday, which are going to be pretty big. Jobless claims will be released 8:30 a.m. on Thursday, and then also Federal Chairman Jerome Powell will be discussing the economy on International Monetary Fund panel on Thursday as well. But other than that, nothing too big will be coming out until at least Thursday of this week. So stocks are expected to continue to have a good week this coming week, April 5th, 2021. Here's a story with AMC. So AMC stock has been sliding a bit after their CEO discussed plans to seek approval to potentially issue more stock, raise more money for the company. So essentially what happened is shares of AMC fell about 5, almost 10% the other day when the CEO spoke on CNBC, and he spoke about plans to seek shareholder approval to authorize an additional 500 million shares in like a secondary stock offering. So AMC has been struggling a lot during the pandemic, but they got a lot of positive press when we saw everything going on with Wall Street Bets and GameStop. They were one of the stocks that really benefited from this. They've raised money in other rounds with other stock offerings, other rounds of funding. And now the CEO explained how it's in their best interest to really raise more capital with how their stock price has been doing. Currently, their stock price is still up significantly from lows on January 5th, which were $1.91 per share. He explains how they don't want to dilute the share so much, like dilution is something they care about, but they are asking to formally approve. They're asking for formal approval from their shareholders to authorize another 500 million shares if they wish to. They say this is important to have because it's like a sensible thing to do. The company, there's an uncharted territory. Things going on in the economy is very uncertain. Like, we don't know what's going to happen with movie theaters. Like, Disney Plus is starting to release movies on Disney Plus, their streaming service versus going in movie theaters. We don't know exactly what's going to happen for movie theaters, how they're going to continue to, what's going to happen once things open up. We don't know how they're going to perform. So he says the smart thing to really do is at least have the option to issue more shares or raise more money, because if they raise more money, they can pay off debt at discount or pay deferred theater rents. They can use the money to grow. It's just smart for them to have a lot of cash on their balance sheet with all of the uncertainty right now. So he says this doesn't mean they're going to be issuing 500 million shares right away, or if they're going to be doing all 500 million, but at least with the approval from shareholders, they'll at least have the option to do this if they see that they need the money. It gives them more flexibility. It gives them a little more financial stability with everything going on right now. And that's just something they think is positive, something they think should happen. Good news for movie theaters right now for AMC is that this past Wednesday, the last Wednesday in March, was their best Wednesday they've had over the last year and a half. They said this has been the best Wednesday they have had since the start of the pandemic, because we're starting to see the economy start opening back up more and more people are getting their vaccines. And they said this was the best day by far. North America ticket sales were 10 times what they had been for every other Wednesday in 2021 so far. So things are looking good, but still they said, even with that, it's just safer for them to have this money, have the option to raise more money if they need it. This could drive the stock price down in the short term, but they're saying long term, it's just, this is how the company is going to be able to survive and thrive moving forward. So it's something they need to do. Next up is Palantir. So Palantir, their CEO, Alex Karp, he sold $10.3 million of the stock. He's been consistently selling the same amount every single month. So ever since the first time that they were able to sell shares, he sold about $135 million, about 11% of his stake, when the lockout period for the stock first was, when he was first able to sell shares a couple of months ago. Since then, he's been pretty consistently selling about 1.3 million shares every single month. November, December, January, February, March. He sold about the same exact thing every single month. However, I see Palantir as being a great buy where it is right now. I think in the $23 to $25 per share range, I think there is a lot of upside. It's cooled off quite a bit from all-time highs. At one point, it was over $40 a share. So it's come down almost 50% from where it was. And there is a lot to like about the company. So first of all, they're in an industry that is just rapidly growing. It's a data analytics company, and no matter what business you are, whether you're selling clothes online, whether you're a streaming service, everyone needs to analyze data and learn from it to improve their business. So right now, Palantir, they have about three main platforms, two primary platforms, but three platforms total that they generate revenue from. The first is their Gotham platform, which primarily serves governments and government applications. Approximately 56% of their total revenue is driven by government customers. This is starting to shift a bit because they also have their other platform, which is their Foundry platform, which is mainly made up of commercial customers, which is about 44% of their total revenue. It's just starting to shift a bit because the way they're charging customers is changing. They used to have solely long-term contracts, but now this is changing to be more better for smaller people, like for smaller companies. They used to have long-term agreements, which companies would have to pay a lot of money up front, be locked in for a couple of years. Now they've changed that model, so they no longer have to do these long, big contracts, and that gives them more flexibility to do business with smaller market cap companies. That's going to generate more revenue from them down the road. And so between their Foundry software, their Gotham software, and their Apollo software, they're in a great position to really capitalize on all of the data needs of companies moving forward, and with them changing their business model to really be more accepting of not doing these large contracts up front, that's going to allow for more companies to want to do business and be able to actually do business with Palantir. So between all of that, I really like the company. And one thing that's good is that their business is a pretty sticky business model, meaning that once Palantir has a customer, it becomes increasingly difficult over time for those customers to leave. Once Palantir continues to analyze their data, become integrated in the business, it becomes harder and harder for those customers to leave, and that is great in terms of recurring revenue for Palantir. So between all of those different things, I think Palantir is a great company moving forward, and despite them already being a pretty major data analytics company, they have a lot of room to grow. They're in only 8 out of the Fortune 100 companies, 12 of the Global 100 companies, and 24 of the Global 300 companies. So they still have a lot of room to grow, even though they're doing big deals with the government, with companies like AWS, Microsoft. Even though they have those big deals, they still have a lot of room to grow, and they're nowhere near reaching their full potential yet. Here's a story with GameStop. GameStop just made its third hire from Amazon as the game retailer continues to poach new executives from tech giants. So GameStop, a lot of people are saying the only way it can survive is if it becomes Amazon, if it becomes the Amazon of games, similar to what Chewy has done for pets. So already GameStop has had one of the founders of Chewy on their board. They've had Cohen, who was one of the founders of Chewy. He has been on GameStop's board, and since he's been there, they've been made a lot of different changes. They've hired a couple of different high-level people from Amazon. They've also hired more people from Chewy, and now they just hired another former Amazon leader to help build out GameStop, potentially, try and turn the business around, make it become the Amazon of games online. So Elliot Wilk, who was former leader at Amazon, is joining GameStop, is going to serve as the company's new chief growth officer starting April. And Wilk, he oversaw a lot of different initiatives at Amazon. He's going to be joining GameStop in addition to other Amazon high-level people at Amazon who joined GameStop, such as Jenna Owens, who was Amazon Fulfillment Director, former Amazon Fulfillment Director, and former Amazon Web Services Engineering Lead, Matt Francis. So all of these people have joined GameStop's executive team, and things have been changing very dramatically ever since Cohen joined GameStop, and they're truly trying to become the Amazon of games. Are they going to be able to do it? It's going to be very hard because the gaming, mobile gaming, online games, game consoles, this industry has changed dramatically. They no longer need discs. A lot of these platforms like PS4, Xbox, you could just install software directly onto the consoles. So and that sort of cuts out one of the main things that GameStop used to do to generate revenue. So they're going to have to really change things up still. Even though they can't just sell games online, they're going to need to change up their model completely. But at least with a lot of high-level people from Amazon coming over, being on the board, being on the C-level team at GameStop, with Cohen being, on the board at GameStop, they have a good fighting chance, in my opinion, to really now make that change over to being the Amazon of games. So we'll have to wait and see what happens there, but at least there is a good chance now with all of these people from Amazon and Chewy all coming over to GameStop. And finally, Mark Cuban, he explained his cryptocurrency portfolio the other day, and he said how he owns a lot of Ethereum because he thinks it's the truest cryptocurrency to being like a true currency. He thinks it's the closest to being like a true currency. Currently, he broke down his portfolio for cryptocurrencies, and he explained how his allocation is 60% Bitcoin, 30% Ethereum, and 10% the rest. So Bitcoin was created, about 10, 12 years ago. And since then, he has explained how he's been watching it for a while now. He's been invested. He's never sold any of his position in Bitcoin, but he explained how he's never really thought it's going to be like a currency. He says it's just not going to work. He says he does believe it's a good store of value, and it's actually better store of value than gold because of the scarcity, because of the algorithmic scarcity and how there's only ever going to be 22 million Bitcoin ever mined. So he says he does believe that is a good sign. So like it's a store of value, but he doesn't believe it could be a true currency. On the other hand, he came out and said that he's very interested in Ethereum. He thinks that Ethereum, which is the second largest cryptocurrency by market cap, he says that he thinks that this is the closest thing to a true currency. He says it's built, this is mainly due to the smart contracts that it runs on, and because it gives the ability for programmers to change and adapt it over time. So he says what he really likes about it is everything with smart contracts. He said smart contracts came along, and they created DeFi, decentralized finance. They created NFTs and non-fungible tokens, and that has been what's changing the game over the last couple of years, and he thinks that's what's going to continue to drive growth more and more over the next couple of years. He thinks that's why it's the closest thing to the internet, why it could be the closest thing to a true currency, because it can be customized and built upon to, which like Bitcoin, it just doesn't have the same use cases as Ethereum. He says Ethereum is the second largest position in his portfolio. It makes up about 30% of his portfolio in cryptocurrency. 60% is in Bitcoin, so he still believes in Bitcoin, but he says a large portion of it is in Ethereum, and then 10% is just in the rest. He didn't specify what, but just in other things. So it seems like he's pretty bullish on all cryptocurrency in general. Specifically, he likes Ethereum in terms of being a true currency, and Bitcoin in terms of being a store of value. He likes that even better than gold. So that's really all I got for you guys today, but I hope you enjoyed today's video. Don't forget to get your 4 free stocks, each valued up to $1,600, when you download the Wrubel investing app using the link down below. I hope you enjoyed, and I'll see you guys in the next episode.